Okay, good afternoon, everybody. Thanks for coming. And David, thanks for having me again at Timing Research. This is one of the broadcasts I love doing because typically the attendees are um, a little more hands-on and a little bit, I think, smarter than some of the people I've had the chance to talk to over the years. So I want to go ahead and get right to work. I'm going to say some things today that's going to challenge the way you see the markets and the way you view your participation there. Some of it you may not like hearing, and I would encourage some dialogue on that. At the end of the broadcast, I'm going to show you how to get a hold of me if you want to talk more, as well as I've got an opportunity to review some data. Some of it's free, and some of it, of course, requires you to make a small investment, but we'll deal with that later. Before we get started, though, it's really important that we're all on the same page because, I never know who's listening and what their background is. So I always like to tell people before we start, it's real important. I think everybody here is on the same page, but it's real important for you to know that trading in futures, options, and off-exchange cash foreign currency transactions, which is Forex, involves a substantial risk of loss. It may not be suitable for all investors. I think you should carefully consider whether trading in futures, options, Forex is suitable for you in light of your circumstances, knowledge, financial resources. People can and do lose money. In rare cases, you could lose more than you invest. Opinions, market data, trade discussions, everything we could talk about in that regard is subject to change at any time. And now that everybody's happy, we can get right to work. So before we get started, I want to talk just a little bit about me because some of you may not know much about me. Shocker for you, I was not always a net winning trader, right? I started as a customer, just like everybody listening. I was a customer. I had an account open, started in 1986, did my very first trade as on the Chicago Board of Trade as a customer. I did the Chicago Board of Trade big board corn, as a matter of fact. And I endured a painful process of daily work that almost killed me. I talk about those details in my second book, which is called The Art of the Trade. That's available on Amazon anytime if you want to look. Some of you people, I think, have read it. I had to discover something about the markets in order to win. Just like all of you here are trying to learn, everybody has to go through this process. There's nothing you're learning that's any different than anybody else. It's all the same stuff. And what I learned was there's no secret to this. And I don't believe trading is a very difficult thing to do. I think there are a lot of misconceptions most people have about trading, and I intend to clear a lot of that up for you today. And I have some very powerful tools to offer you in that process. In my opinion, your misconceptions that you have start with your understanding of education and training. And learning to create a winning environment, you got to learn different tools. And your results will improve significantly in a very short period of time as you apply those new tools. And I need you to remember what you're up against. Almost no one I've ever talked to in education, training, marketing of trading systems, electronic assistance, whatever it is that you have access to as your tool set, almost nobody has ever talked about the problem you're really facing. And that the odds really are stacked against you, not the guy sitting next to you, not somebody out there that, oh yeah, he doesn't know as much as I. That's no. The odds of you winning are stacked against you, and they're almost not overcomable. They're about 85% of traders lose. And this isn't opinion. These are facts. I'm going to show you this in a minute. And most, if not all of you listening, have had at least one account you lost heavily in. You have. And my question to you is, how are you going to beat the odds if they're stacked against you when you're using all of the same tools everybody else that's losing is using? See, the price I paid to learn this, I had years of net losses and debits. And I spent all kinds of time with problems, bankruptcy, loss of credit, no bank accounts, one step from homelessness for years at a time, owing back. The list goes on and on and on. And every time I made money, when I had an income, I put that money right back into learning. More and more, I'm out the markets in this futile attempt to learn how to turn all this around and make money. And then one day for me, it happened. And I almost didn't sleep for 3 days. I experienced what people call an epiphany. And when I say I had an epiphany, what I mean by that is I discovered something about the markets that made all the pain and suffering worth it. I learned how to do this for real. Now, I had no idea what trading was really involved because, like most people listening, I had bought into the same story about study and analysis and education and systems. Somehow there is some secret to it. And what I discovered is what all the winning traders already know. There is no secret. And after I changed my thinking process, I started to find more consistent success. I'm going to share some of that with you today. And I never look back. I've had losing days, losing weeks, losing months, occasionally a losing quarter, but I haven't had a losing year, and I can't remember how long. And I learned the essential difference between net winning traders and net losing traders. What's the essential difference? I'm going to share you 5 of the things right now that make all the difference. Now, I'm going to put something on the screen I want you all to look at real quick. Does anybody recognize this by any chance? Do we know what this is? Probably not. This is a painting from Osaka, Japan, and it shows the Osaka rice market around the time of our first trader we want to talk about today. And we're going to talk about basically 2 traders that I think are a significant amount of information we can gain from their lives that I think makes all the difference. And the first question that you need to ask is, ever heard of this guy, Munishi Homa? Anybody heard of him before? Any yeses coming in, any no's coming in? What Homa taught us isn't new. It's just more like forgotten by most people in the markets today. And I don't even think it's forgotten so much as ignored by almost everyone trading. Homa intended that traders come to an understanding that this business of successful trading is about understanding what people will do under certain circumstances. He didn't concern himself with prices. For example, he showed that when the market was unusually bearish, a price rise was due and vice versa. And basically what he came to understand is that he learned the psychology behind how this works. And he wrote the first book on trading psychology called The Fountain of Gold. And he lived in the 1700s and amassed a fortune that was somewhere north of 10 billion at the time he finally quit trading, starting from nothing, the equivalent of today's money. What was it that he did? Well, he's considered the inventor of Japanese candlestick charting, but that wasn't his intention. He never intended for people to use charts to trade with, but rather to use those charts to discern when a price change was coming. You know, sort of like more like you and I would use sort of like the I Ching. You know what I mean? It wasn't candlesticks is a method of learning where prices are too high or too low, which some people believe, but rather they're a method of understanding how people are thinking and behaving and acting so you can prepare yourself for the next wave of behavior. See, it's really important to ask yourself this. What is it that I'm really doing here? Have you ever heard any of these things before? You must be willing to go against the crowd. Everybody's heard that, but what does that mean? You must be willing to think differently. What does that mean? You must not listen to common knowledge or the crowd, right? Buy when prices are low and sell when they're high. Well, what does that mean? You know, basically the bottom line is this right here. This is what he said. It is the thinking behind the tool, not the tool itself, that is the key to profit. If the only tool you fully understand is something like a hammer, you're going to see every problem in your life as a nail, because that's what hammers are made for. What happens when the problem isn't a nail? If all of your trading is based on a set of rules and principles that you learn from some method of thinking that you were taught or believe is systematic, you're going to see every market condition as that issue. I suppose the market isn't in that frame of mind. You're using a tool to trade a market that isn't thinking the way the tool thinks, therefore your losses will increase. You're going to be in the wrong spot. So what happened since the 1700s, right? What was it that happened over the years from when Homa decided to give us this gift of understanding market price potential? Well, major focus on technical analysis and math. That's what happened, right? I think it's the biggest loss of focus and knowledge experience since trading was invented. People took what was developed and turned it into a set of formulas, math and science. when the intention Homa had was something completely different. Science is right, right? Numbers don't lie, right? The markets aren't science and math. They're people gathering together to argue over a price in the market that they believe isn't fair. What does that mean? That's something different than charting and analysis, isn't it? So the creation of countless indicators, oscillators, prognosticators, artificial intelligence, machine learning, charting methods, all of this developed out of what? The process of crunching numbers, because numbers don't lie, science and math, right? Well-meaning people, well-meaning marketers are selling what they believe will answer the question of where to buy and sell for profits. That's what all of the education and training all over the globe has anything to do with futures, options, or Forex. That's what they're trying to do. They're well-meaning people that believe they think they've got something that'll help flatten that curve so you won't be in the 85% of people who close out their account at a loss. And if you're listening, you know that's already happened at least once for most of you. So how come learning everything there is to know from the foot of the master, someone like Steve Leisman, as far as candlesticks might be concerned, hasn't really made a difference in your profitability? So if you've been struggling up to this point and trying everything and it's just not working right, maybe you're making a little bit of money, but you're not slamming home the home runs, or most of you are breaking even when you could easily be making money, worse yet you're losing. If you're in that ballpark, it's really not your fault, really. You're simply unaware of something else. People believe things about the trading world that are simply not true, and they don't even know there is something different that they could be doing. In other words, you don't know what you don't know. That's why you don't know it, because you don't know it. What is that extra something that you're missing? Who's the greatest trader of them all? And I know you're all thinking the same thing, right? Jesse Livermore. How could we not spend at least a minute on Livermore, right? His life story was written as a novel called Reminiscences of a Stock Operator by Edwin Lefebvre. And Livermore, in my opinion, greatest trader that it's ever been. There's a quote from Livermore. There is no bull or bear side to the market. There's only the right side. Prices move along the line of least resistance. Well, what does that mean? Livermore was also quoted as saying more than once that he considered chartists, people who study the markets by putting dots, lines, ratios, curly Q's, little dots on a chart, trying to figure out where this market's going to go in price. He considered those people freaks. At one point in his autobiography, he called them pet monkeys employed by the brokerage firms. He never met anyone making money who used them. That's why. Nobody made any money using charts, graphs, statistics, and all the rest of that stuff that we think today is the key to making our fortune. Only the opposite. Chartists were always losing all the time, 85% of them. Livermore, like Homa, understood that trading is about people, not patterns, prices, numbers, or anything else for that matter. Now, I'm not saying that you can't use the existing tools that you've come to trust. I'm not saying you can't learn more about price action in the market to enable better potential odds in your favor. What I'm saying is you have to have an underlying bedrock change in your thinking about why you value those tools and when and where you choose to use them. That is a process of understanding trader psychology more than anything else. And when I teach my 8-week trading psychology seminar online to traders, I've done it for traders all over the world, we use the books by Livermore and others as our textbooks to understand why the psychology behind this business is so important. So here's the problem. People just simply forgot. They ignored simplicity and common sense and the wisdom that's provided by just these two great traders, let alone the many of those that are out there. Market was mystified. People who educate traders have completely lost sight of what professional winning traders know and what they do. Traders today have fallen for a complete misconception of how and what is required to win. Now, that's my opinion, of course. Some people don't agree with that. And like I said, I'm going to challenge some of the concepts that you've come to rely on, and some people will just not accept that. That's up to you. Endless studying, charting, analysis, calculations, projections, all based on some mathematical computation, leads to loss. And this is a bold statement. I want you to really hear this. Not a single winning trader puts their confidence in these methods. You really should really hear that. People who are net winning traders, consistent, seven-figure people all the time, do not use all of the methods you think are so important and you're learning about consistently. If they use them in a different way than you might be familiar with for different reasons. That's where they can increase their edge. But the thing is, they know what their edge is because they focused on something different. And because of these things, the typical trader has little to no potential to create gains. 80 to 85% or more of all traders will close at a net loss. That money goes where? To the winner. We want to demystify the markets, guys, right? And I want to help set you on the right track, really help you come to some understandings here. And before I actually experienced my epiphany of understanding, I had a potentially life-changing experience, but I didn't make the connection at the time. And this is what I'm going to do. I'm going to set you on the right track right now in a very simple way. Now, what I'm going to share with you can go really deep for a lot of people over a long period of time, but this is the starting point if you want to start taking what you know and augment it to a really win approach. I met a wheat pit trader. This is when I was back still living in Chicago. And he told me what the secret to trading really was. And this man traded every day. Just like you, just like me, every day he was in the pit trading. You know what he told me? When everyone is buying, look for a place to sell. When everyone is selling, look for a place to buy. This guy didn't even have a college. He barely finished high school. What's the simple solution to this? When I was younger, I studied martial arts, specifically karate. Although I was a big fan of Bruce Lee, there was no kung fu schools in Bolingbrook, Illinois in 1970. One thing that was a big draw for me was that when my sensei demonstrated his skill at karate by breaking a few wooden boards in class one day, I thought it was phenomenal. This guy had a punch and a kick and he could break boards. Powerful. He promised he would teach me how to do this when the time was right. Well, after more than a year of training and discipline several times a week, he felt I was ready to learn this skill. I was very excited, and then my excitement faded to extreme disappointment. What he showed me was so simple and required no special skills or anything. I couldn't believe he made me wait to do it. I could teach you how to break a wooden board right now in 2 minutes. Save you all the workouts and bad clothing. There's a weak spot in the board. Once you know how to find that, that's where you concentrate your effort on. Well, what about the markets? There's a weak spot in the markets too. You just have to find the market's weak spot and put your position on. To find that weak spot, you just have to know what to look for. Next, if you know how to manage your trade, you can be profitable regularly. And I'm going to show you the simple steps we teach at Net Winning Trader right now. Remember, you have to think different and do different things if you want to have a different result. You know, one of the descriptions of insanity is doing the same thing the same way all the time, expecting different results. You need to make a change. You need to know what that change is. So let's start at the foundation, show you what you need to know to create the process for yourself. In other words, these 5 factors, this is a starting point for what you need to focus on. Everything else will then begin to fall into place. Okay. First thing, losses create pain. Anybody out there ever experienced a loss, right? The market is a pain amplifier. The loser is in pain. The loser will do anything to relieve that pain. The typical average trader is losing, and that's painful for them. To avoid pain becomes the goal of this person. Therefore, this trader will use everything and anything he can possibly think of to lessen the pain he feels from losing. That's why people who try some approach, it doesn't work, they're in pain, they try another one and another one and another one. They keep trying stuff, never able to resolve this pain problem. And the pain avoidance process is the same for every losing trader. Therefore, they all do the same thing almost all the time, creating a weak spot in the market regularly. In other words, all the people that want to avoid pain on the buy side will eventually quit and sell their position off at a nice loss at some point, and they'll do it all at once. That's the weak spot in the market. That's your time to buy. Vice versa is your opportunity on the sell side. By focusing on these weak spots, we can create opportunity out of someone else's losses, meaning their pain and desire to avoid pain becomes our profit pathway. The profit paradox. I want to talk a little bit about the profit paradox. And this is really important. It's the wrong focus is the problem. Losing traders attempt to reduce their pain by increasing their number of winning trades. Their goal is to get to 55, 60, 65% winning trades or more. This is not likely under most circumstances, and the probability of maintaining these high win percentages also is statistically unlikely. Most of the people who make the most money in this field have win-loss ratios around 44 to 48%. They're losing more than half the time. They don't care, for a different reason we're going to talk about in just a minute. Here's a quote from a guy named William Eckhart. For those of you who don't know who William Eckhart is, he was one of the Chicago Turtles. Many years ago, there was a trader in Chicago. His name was Richard Dennis. And Richard Dennis took a small grub stake of around 5 to 10 grand. The number varies depending on who you talk to. And turned it into a fortune probably close to 400 million in a very short period of time, 10 or 12 years as a pit trader. And he had a number of things he said. One of the things he said is, I could publish my trading method on the front page of the Chicago Sun-Times and people would lose money using it. So he taught a handful of hand-picked guys how to really use a winning trading system and what's really important to win. This is what one of those students said. The desire to maximize the number of winning trades or minimize the number of losing trades works against the trader. The success rate of trades is the least important performance statistic and may even be inversely related to performance. In other words, you want to really win at this, maybe you only need 5 to 10% of trades to work for you if you know exactly how to cut losses and let profits run. Let me show you something that's going to astound you. Now, guys, I told you, I'm going to challenge your point of view, and I'm going to do it right now with somebody else's numbers. This is not my opinion. This is factual evidence produced by the market itself. I want you to look at what you see here. These are percent winners across the board in about 18 different, I think 16 different currency pairs traded at a very large brokerage firm based in New York. If I told you who, well, I'm going to tell you, okay, the Forex.com, Gain Capital. That's where this data came from. And what this shows is a year's worth of data, millions of trades done by their customers, showing on average the winning pips on a winning trade, which is the green bars, losing pips on the losing trades, right? So, or I'm sorry, percentage numbers. I'm sorry, percentage numbers, not the pips. So that's next. This is the percentage. So of all the millions of guys they had trading in dollar euro, this is how many winning trades they had versus losing trades. These are good. Look at this one in New Zealand, 70% winning trades. This is astounding data, right? You would think all these people are making tons of dough. Nope. Here's the same data compared for pips won versus pips lost. Even though these traders had a huge number of percentage winning trades, they never made any money. The winning trades produced half as much gains as the losing trades did. So no matter how big their winning percentage ratio was, the amount of money they were taking out net to cover from those winning trades to cover their losses was never big enough. Most of the time it was 2 to 1 the wrong way. Again, this isn't my opinion. This is from this is from someone who runs a brokerage firm. Win-loss ratio. You have to take more money out from your winners than you lose on your losers. And in the data I just showed you, what do these losing traders have? They have it the other way around. They're losing twice as much money on their losing trades than they win back on the winning trades. So even though they're winning at a high percentage, they have no chance. Another quote by Bill Eckhart. One common adage that is completely wrong-headed is, you can't go broke taking profits. And that's precisely how many traders do go broke. Amateurs go broke by taking large losses. Professionals go broke by taking small profits. What does that mean? You got to hold your winners. This isn't new. You've heard all this before, but you don't do it. Holding winners is the cornerstone to successful trading, right? It should be obvious from the data that I just showed you that the entire universe of traders doesn't have this skill. Otherwise, there wouldn't be entire companies worth of traders losing twice the money they get from winning. You need to have a method for this simple thing. Hold your winning trades. Otherwise, you can't pay for your losers. You have to find a way to hold winners. Jesse Livermore, listen to this. After making and losing millions of dollars, I want to tell you this. It never was my thinking or study or method or system, right? It was never my thinking that made the big money for me. It was my sitting, right? My sitting. Got that? My sitting tight. That's all he did. He get on a winning trade, didn't touch it. Now, we teach methods for holding winners that are considered unconventional, right? Such as turning off the screen and going for a walk. You got a winning position on and your stop loss is in working for you. You turn the screen off and go for a walk. Most people can't do that. They would experience a huge amount of anxiety over what is the market doing to me. Market isn't doing anything to you. If you have correctly identified where the weak spot in the market is, then you're going to get a lead on it. Next question is, how far is it going to go? We don't know how far it could go, so don't touch it. The point is, you have to develop and maintain the skill, or you can't benefit from your system's probabilities. See, one of the problems that everybody listening has is you don't really know what your system probabilities are because you're collecting the wrong data. You want to operate on higher time frames. Using higher time frames is significant for winning traders because it removes the tendency to think that random noise in the market is statistically significant. In other words, the market bouncing around between two close price points on a 5-minute chart has nothing to do with how a daily, weekly, or monthly trader might view the entire day's worth of trading. So trying to be in and out all day long, trading inside this bouncing around, when you could simply just put a position on and wait for the market to make a large move, that's the difference between winning and losing. Net winning traders know that it takes significant amount of time for all market participants to reach liquidating conclusions. Winning traders know that they can't get paid unless the losing trader takes a loss. It takes time for the loser to decide to take the loss he is typically holding. Therefore, the winning trader is waiting out the losing trader. He knows the losing trader will make his market exit for reasons that have nothing to do with successful trading. I'm in pain, get me out. I can't hold this over the weekend. I don't have enough profit in it. I better just take it now and wait for tomorrow. That has nothing, all of that thinking has nothing to do with how the market itself is structured and what price move it's preparing to make. All of that is self-imposed limitations that you bring to the table. Typical losing traders are operating on time frames of less than 30 minutes. What that means is they're studying the market on a 1 minute, 2 minute, 3 minute, 5 minute, 7 minute, 10 minute, 12 minute, 15 minute, 30 minute time frame. And all that's random noise. The winning traders are usually using time frames of 60 minutes or more. And they wait for the close of the bar and they try to anticipate where the wicks are, because the wicks show what? The wicks show a large interest in doing something at a price point. Who is on the other side of those trades? You got to add to your winners. This is something almost no one does. Nothing will help you reach top level performance for your account faster than the commitment to add when holding winning positions. 100% of all net winning traders have a method which they use to add to winning trades. One of the best books I ever read about market psychology and trading was called Zen in the Markets. One of the things that this guy did, the author did, is he put photocopies of his trading cards in the book. He showed conclusively how his profitability was increased 5, 6, 7-fold by adding to the, every time the winner was on, he would immediately add to it and add to it and add to it and add to it and add to it as the trade worked. And he would roll his exit price point behind all the, until he might put a position on that had 10 or 12 active trades on it, all of them at a small profit. And that dropped to the bottom line when he exited. His losing trades were always one lots with the risk he was willing to take. Livermore, when I am bearish and I sell a stock, each sale must be at a lower level than the previous sale. When I'm buying, the reverse is true. I must buy on a rising scale. I don't buy long stock on a scale down. I buy on a scale up. In other words, as long as the market is moving favorably for the position, push the advantage. Record keeping. Trading is a business, so treat it like a business. Keep good records of your participation. You know, if you ran a shoe, if you ran a shoe store and I asked you, who is your best customer? What days of the week do you sell the most shoes? If you run a sale, when do most people come in? On the weekend or during the week? You know, this is important data to sell a lot of shoes. If all you did was say, well, here's the amount of money I have in the cash register every morning. What are you doing? You have no data to help you improve what you're doing. Keep good records of what you're doing. Most traders are not keeping the sort of records that can be used to improve their results. They keep the sort of records that make them feel good about what they're doing, like percentage wins, largest gain, how much time I'm in my winning trades. You know, that they're keeping that kind of information, but they're not keeping the information that really tells them what they need to know. What they need to know, you need the records that can help you improve two things. There's only two things you need to be consistently, constantly improving, and you need data to help you do this. And the data you need is not from the market. The data is generated from your own participation. So how you play the game needs to be studied just as much as your knowledge of the game. So how are you playing the game? Here's the two things you need to improve all the time. How do I hold my winners better? Improving your win-loss ratio. Now, again, it's not percentage of wins, it's win-loss ratio. The ratio you're looking for typically is 2 to 1 or better. In other words, when we talked about before, when I showed you the winning trades, the amount of winning percentages to the losing dollars, what you want is a minimum $2 out for every dollar you give back. If you do the simple math on that, even at 42% winning trades, if you can pull $2 out every single time you lose $1 on the losers, you're going to make more money than you lose. Simple math. Just do the math. You'll see that. So summarizing real quick, winning at trading is a very simple proposition in my terms, as far as I'm concerned. All you really need to do is follow in the footsteps of this forgotten and timeless wisdom. Focus on win-loss ratio and not your win percentage. So how do I get more money out of my winners? How do I reduce the risk on my losers? Hold those winners. Operate on higher time frames. Don't be playing this game in the random noise. Play it for where the push in the market is. Add to your winners. And the last one, properly document what you're doing. These 5 things are the things that net winning traders focus on and spend all their time on. It's not on anything else. Very little. I spend less than 5 to 10% of my time on things like charts and graphs and news reports and all that kind of stuff. The program that I offer at Net Winning Trader provides you with tools to creating winning method, right? So you're welcome to visit my site and have a look. Anyone for a slice of cake? My mother told me that if I could read, I could cook. And that's really there is to cooking. Simply read the recipe and do what the recipe says to do. That's it. Obviously, you get better at it as time goes on, and you don't make stupid mistakes, and you learn how not to burn butter, and you learn how to properly, heat milk, and you learn how to let something sit long enough so the flavors blend. I mean, you learn all that, but if you can read the recipe, follow what it says to do, you get a cake, right? Trading to win is like baking a cake. Simple recipe you have to follow. If you follow the recipe, you end up with a cake. If you don't follow the recipe, you get something else. To win a trading, simply follow the recipe all winning traders follow. And there is no mystery to it. There's no secret. There's nothing that you need to learn more than what you already know. In fact, most of you know more. Stop and think about this. All of the big fortunes, the real big fortunes that have been made trading in futures, options, Forex. I mean, Livermore made $100 million in one day when $100 million was a lot of money. He routinely had $50 million years. Started with nothing. Rode a horse to work. There was no computers. Most people didn't even have indoor plumbing. You know what I mean? There were all of these fortunes, big traders, Sam and Chase, other big names that were, we could go on for hours. They were all made Homa, a fortune worth more than 10 billion in today's money. All these people, before computers were even invented or even an idea in someone's mind, right? Today, what's slowing you down? Your focus is on the wrong stuff. So in conclusion, now you know how to become a net winning trader. So thank you for attending. This is it. That's all there is to it, in my view. Here's my website. You're welcome to kick around for a little bit there. There's some free stuff, as well as you can sign up and ask for an interview and we'll talk, see if we want to work together and work on your trading skills and abilities. Discount code is the Lion Online. Now, what does that mean? Well, if you type in the Lion Online, if you decide you want to participate, type in this code, you'll get a nice discount. Now, if this code doesn't work, because my web guy may have changed it without telling me, let me know. I'm a real guy here in my home office. All you got to do is follow the instructions on the website. You can find me, no problem. You can also go to my other website, theliononline.com, which is a companion website for this offer, which is a copy of my latest book, The Psychology of Trading. I have 4 books published, 3 by Wiley & Sons. This one, The Psychology of Trading, is self-published. And I did that to maintain control over all the things that are important. Who gets it, why they get it, price isn't too much. It's only $10. Best $10 you'll ever spend in trading, in my opinion. So have a look around. There's a free intro, the free few pages of the book. All you got to do is go there, click the link, start reading, see if you like it. If you like it, you can get a copy for next to nothing. It's what they call a online book. It's a Kindle. I don't believe you need a Kindle to read it because it will download, and you can get an online reader if you need it. But in any case, you're welcome to have a look there, and you can get a hold of me at Net Winning Trader. Now the floor is open for Q&A. We've got a little bit of time left before the next presenter, so I want to go ahead and open the floor up to question and answers. And again, I don't have the Q&A chat window open for some reason, so I'm kind of relying on David. And I hope we have a couple of questions in there, but I will mention this real quick. I don't want you guys to think that I'm trying to oversimplify what's required to win. I'm not trying to oversimplify the process that you're going to have to go through. You're going to have to make some changes to what you already know. And most of what those changes involve are things inside your own head, your own thinking, your own emotions. These are things that you don't want to change easily because you consider them a part of you. They're who you are in a lot of ways. Well, we can take all that under advisement And human beings are the only creatures that we're aware of that we share the planet with at this point that can change his method of thinking anytime he wants and change his life anytime he wants. Most of us live our lives like, I think it was Thoreau said, lives of quiet desperation. We're just trying to get through it, you know. But some of us look at the markets and say, you know, if I could figure this out, I could make more money than I could ever need. And all those things that I really want to do, like learn to build an airplane or spend the weekends in Jamaica or take a month off and go through Europe with my wife during the summer. All that stuff just requires enough money. And the markets, you can clearly see, can offer you the cash in huge abundance. But you can't get any of it until you're willing to hear its real voice. And the problem is most of us have tuned that voice out because we filled our lives and our thinking with a lot of stuff that really doesn't go that far towards the goal of winning. You know, you look at top performers in any field. I don't care what you look at, top performers in every field. They all have a coach. I don't think you can make a fortune without some person that you are willing to feel is qualified to assist you for at least some part of your trading growth and development. You need a third part, pair of eyes looking at what you're doing to say, okay, I know why you're doing this, and this is where your problem is. You need to find a good coach, a good mentor. I think that process is not right for everybody all the time, but when it is right for you, it can make a huge difference. I think also that trading is a learnable skill that anyone can learn to do. Anyone. I don't care who you are. You know, I have this conversation with people all the time when somebody tells me about how they're having all these problems in business and they can't make things happen for them and all the rest. And I go, well, let me ask you a question. How come some guy can float across the Pacific Ocean on a piece of plywood from the Philippines, land in California, doesn't speak the language, and 5 years later, he owns 2 7-Elevens, a house in Beverly Hills, and his kids are going to private school? How does that happen? Is that because he got lucky? Or is it because he brought something to the table and was willing to do something to get where he wanted to go nobody else is willing to do? So anybody can learn to do this, but it might require you to make some changes to what you're doing that really are unique to you. So make the changes. Maybe you're going to need some help to do that. That's okay too. But I don't want to discourage you by thinking that this is a big deal. It's not a big deal. I don't want to oversimplify, but at the same time, you got to take it for what it is. You know, some of the best things in life come after making the best efforts. That's why it's worth it. So that being said, I'll open the floor up, the conversation. How are we doing there, David? Do we have any questions?
All right.
Comments?
Yeah, we got a couple here. So Don says, or asks, do you think the best way to protect a winning trade is through a percent trailing stop or a stop loss set to previous support and resistance? And then the second part of the question is, when setting one's original stop loss, is it best to set at a previous support / resistance or set a number of points / dollars?
Okay, what the question really is where's the best place to exit? Would you agree? Whoever that customer is, he says, where's the best place to exit? Because obviously, if we're in a winner, we want to hold it as long as we can. We don't want to get taken out early, right? So where is the best place to put your exit order? That place is always at a price the market can't get to easily. So let me show you real quick. Can I just show my screen real quick?
Yeah, you should.
Okay.
Oh,
I don't know. Let me
You
see what.
you might have to, if you're going to switch to a chart, you might have
No,
to.
I want to do this real quick. I want to. How come it won't? Oh, because I got to end the slideshow. Hold on a second. I'm not going to do that yet. Let me do this real quick. Hold on. Don't go away, everybody. All right. Tell me if you can see this on the screen.
Um, okay, yeah. Now we're seeing a chart.
Okay. This is my personal trading chart of the dollar yen on the 60-minute time frame, and these red and greens are proprietary signals that I know how to use. I don't want you to look at those. It's not, oh, the market's got a green, so you buy. No, it's an indication point, and each kind of signal means something different. So I don't want you to listen to that. Just put all that aside. Just pretend it's not even there. I don't want you getting confused over how I do this, because that's not the question. The question is, how do I manage my risk? Okay. Let's say you wanted to join the downtrend, right? Here's a downtrend, and you want to join the downtrend, right? And let's say you decide that you want to be a seller on the next breakdown to a new low. Okay, so right here, you'd be short. Now, what do you want to do? You want to hold that till the market turns. So what's the price level it hasn't been at? It can't get to. That's usually the other side of one of the moving averages. So as long as the market stays below one of the moving averages, your probability is good that your downtrend is still in play. So you might put your trade on the breakdown here, and market goes short. So you say, okay, that's my strategy. My strategy is I go with breakouts. Okay, fine. Here's your breakout. So you'd get short there, and you'd be short all the way down. And then when the market crosses the 50-bar moving average, that's what the blue line is, that's your exit stop. You would have gotten about 80% of the move for that week. Not a bad trade. You roll it down to a point where the market can't get to easily. If it gets to that point, it means something is changing. So why would you want to be short if the market's going long, it's going buy interest? You wouldn't. That's over. Your short's over at that point. So you're looking for a place where the buyers are gaining dominance. Well, that's right here. See this wick at the very, very bottom for this week? The weekly low was a wick that resulted in higher prices above the moving average. Every time the buyers tried to do that before, here's a hook reversal, hook reversal, hook reversal, where there was a big wicks involved, they weren't able to do it. So you'd stay short. When they were able to gain control of the market, your short's over. So this gives you enough wiggle room. You follow me? Same is true on the long side. You'd buy where you price, whatever it is you use to buy, you keep the exit order on one side of the moving average. Now, you don't have to do that. You can do it in percentages. You can do it according to your tolerance for daily risk. You could do it any number of ways. But the whole point is find a method that answers the question, where is the loser staying a loser? Until that goes the other way, I want to stay with this trade. So I found from my own personal trading that when I am in a market and it's working, the best point to liquidate that trade is when the market crosses the moving average, stays above it in the case of a short, or stays below it in the case of a long, right? Where they cross and all the rest, that's not as important. The important point is the control in the market shifted from short to long. So short's over. You don't want to pick a number and say, I'll hold it to this point because that's the biggest trade I've ever had. No, just let it work. Obviously, you should have been adding to it. Every time it broke down to a new low, you should have been adding to it, because that's your style. Sell a breakout to a new low. So you would have gotten short here, let's say, and you would have added to it here. You would have added to it here, taken a little heat, but then new low, could have added to it here again. You see what I'm saying? You'd have no problem with that trade over that period of time. When the flow in the market, the order flow in the market went from offered to bid, the shorts lost control of the market. So at that point, I'm out. That's where you should be out. What point is that? And let me just remind you, you're not going to get it all. You're not going to be the guy that sells it right at the top right here and holds it and covers it right down here. That's not going to, you're not going to do that. It's unrealistic to think that. Now, maybe you'll get good enough to be able to pick some really nice entries and a little bit of lady luck involved. You happen to hit the exit button at just the right time. But this is going to be all the time. You see what I'm saying? That's not realistic. But I hope that answers your question. To maintain profitability, get the most out of the trade, whatever your method is, whatever your style is, where is it hard for the market to get to? Place your stop there. So every hour or every 2 hours or every day, you just roll it to the other side of this average until finally you're hit. Make sense?
All right. Yeah. Sounds good.
I have couple of, I think I found the chat window. So
okay.
let me see if I've got, where are you at on this? So can I move my, when's the last time somebody put something in? I say 552 here.
Yeah. So actually, Don, that was the last one to comment there, was asked the, the question, but
do you use volume to hint the power in the market? Yeah. High volume means the market's busy. Why is it busy? Why does everybody want to do something right now? So high volume indicates willingness to participate. Who's winning, who's losing, when everybody's willing to participate. Why are they willing to participate? No volume means nobody sees an opportunity. Why is that? Why would it be that the vast majority of people trading in the markets don't think there's anything to be made today? Well, why do they think that? Well, a lot of times that's the news. They think a piece of news is going to make all the difference. So they won't do anything for 6 hours before the news. And then the market trades down to some low print it hasn't been at in 6 weeks. News is due out in an hour and it's just sitting there. You don't think those shorts from above the market are nervous? You don't think they may try to get out if they get the bad news? You think all the bulls are like, well, maybe this is it. Maybe it's time to get in. If that number comes out bullish, oh my God, I'm going to hit the buy button. You see what I'm saying? It's not what the news is. It's not the fact that the news is due out. It's what is the market doing when it gets to that point? What is the volume suggesting? Is the volume suggesting that nobody wants to play? Well, why is that? The volume is suggesting everybody wants to play. Why is that? What does it mean for a high volume bar with a tight range? Why would it be a tight range? Well, that would mean that everybody who wanted to get long put an order in, and there was exactly enough short orders out there to cover that. And it basically, all the buy orders and all the sell orders were about the same size, the whole bar. So there was no price movement because there was no advantage. Neither side had an advantage, but it was a lot of business going through. Well, that can only mean that this market isn't going to stay at this price because all the shorts think there's a move lower coming and all the longs think a move higher is coming, but they both can't be right. And everybody got positioned right now. So where are the stops? Tight in. The first set of stops it hits, it's going to flush. So maybe the right way to play that market is not to be in, but to put an order on both sides. If the news comes out, let's say, and it's a bullish news, blah, 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 the market moves up and it looks like it's going to break to the upside, it would hit a buy stop to get you long. Then it hits the rest of the buy stops, and that's to cover the shorts that are losing. And now the market's at some new high that's got everybody concerned. Okay, the exact opposite is a 50-50 probability in a situation like that. So put both orders out there. You see what I'm saying? You don't have to figure out what the market's going to do to make money. You got to figure out what's most likely given a set of conditions as to how the market got to that place. You see what I'm saying? Don wants to know, do you think the currencies are the least likely market to be manipulated? Okay, let me mention one thing to you. If you think the markets are being manipulated so often that you can't profit, this isn't for you. Nobody can manipulate the markets. In fact, the market people, the people who monitor the markets, the exchanges, are more sophisticated now than they've ever been. They know when people are trying to game the system. They know when they're trying to corner a market for some period of time, or for some reason, or between two price points. They know all about that, and they know how to catch those people, and they know how to put that money back into the system when the time is right. The probability of you getting hurt in a manipulated market so often that you can't make money doing this is remote. Not a single person on this earth, I don't care who you are, name the biggest billionaire out there, George Bezos, could not manipulate the currency markets if he tried. First of all, he could never open one account for the size money that's required to manipulate the market. Secondly, no matter who it is that opens the account, all of those accounts are cross-referenced at the same firm. So if he opened 100 different accounts with $1 billion in each account, every other account that has his name on it knows about all the other accounts at every other brokerage firm. You're not going to get, the system cannot be manipulated. It is a level playing field. This is why you can open an account for $500 and turn it into $100,000 if you know what you're doing. It's not, nothing's manipulated. It's a very rare thing. It's like, you know, am I going to get sick riding the bus? Well, okay, maybe. How many people get sick riding the bus all day, every day? So they can't go to work without taking a bottle of aspirin with them and running to their doctor every Friday. It's not realistic. That's a good, I understand your question, but it's not a realistic problem to have. So you don't need to concern yourself with the market being manipulated. All right, let's see what this guy says here. I mean, I hope, I'm not trying to discredit you. I'm just saying it's not a reasonable thought. Okay, this guy here, 405. If you're basing your trading ideas on a daily chart, wouldn't you use a daily chart moving average as a point for a trailing stop? Sure. Versus the moving average on a 60-minute chart. Yeah, you could do that if you wanted to, sure. The important issue about what it is that you want to do, you know what I mean? In other words, if you're saying, you know, I want to use some method to manage my exits, right? The important thing there is it needs to be consistent. The whole issue is probabilities, not certainties. One of the things I teach in my coursework here, let me put this up because there is, let's put it over here. Where is it here? Move this over here. Okay.
Hey, Jason, sorry.
Yeah.
I gotta cut you off here.